Looking at the Markets with David Modell.
Welcome to Looking at the Markets with David Modell. Today I have not one special guest, but two special guests, return guests. I'm talking about Captain John Bukowski and Miss Kimberly. And they are both from CaptainJohnCharts.com, which I want everybody to check out. And that link is going to be below this video in the description. Click on that as soon as you're done watching this video. Today we're going to get a presentation about, as you can see on your screen right now, systematic relative strength and chart investing. So both of you, Captain John and Kimberly, welcome back to Looking at the Markets.
Oh, thank you for having us, David.
Thanks, Dave. Happy to be here.
Yeah, I'm always glad to have both of you as guests. I get two for the price of one. It's really great. So I'm ready for your presentation. I'm ready to learn a lot about charting today. So what do you have for us, Captain John?
Well, today we're going to talk a little bit about relative strength and then tie in some chart investing as well as a few other indicators that we use and find helpful. And with that said, I want to start with, I think, what is one of the most, if not the most important charts out there. And I'll tell you why. I oftentimes, I've been in the business a long time, I'll run into people after a major pullback. And for example, back in the financial crisis, people saying, oh my gosh, my portfolio went down 50%. I'm going to need 50% to get back to even. It's going to take forever. And I'd say, well, whoa, wait a minute. If you went down 50%, you need more than 50% to get even there. What do you mean? And I said, well, if you drop 50%, you need to get 100% to get back to even. And once you tell them that, they obviously they go, oh, I can't believe I said that. I mean, yeah, I understand. I need to double my money to get back to where I started. And so people don't understand that sometimes. And we take a look going down further on this chart, and I like to point out the 90% decline because a lot of people lost 90% when Nasdaq fell, at least with certain stocks. Well, a 90% decline, you need to have a 900% gain just to get back to even, and we know how long that could possibly take. So going back on Warren Buffett's number one rule is never lose money. And the number two rule is don't forget rule number one. So we think this is very important because we believe that defensive posture is warranted, sometimes more than trying to capitalize on the upside. So we like to play both sides of offense and defense when we're managing things, and we realize that it takes courage. It takes, you need to be able to understand you're going to have losses, and it's much better to take a minor loss than it is to ride something down. Yep. So the next chart is somewhat timely in this discussion because it's very simple in that if you take a look at, in this case we use the S&P 500 going back to 1994. So you've got the one of the greatest bull markets in the beginning. You have the dot-com collapse, then you have another bull market, then you have the financial and housing crash, and then, of course, the bounce and taken off. Now, the important thing here is, had you bought at the top in the dot-com, you had to wait several years just to get back to even, only to give it all back again. Yep. So of course this has been horrible for people, and I'm talking about everybody, people that maybe don't have necessarily an individual account or a joint account. They may just have a 401k. Everybody got wiped out that just held on and was told to buy and hold. You're in it for the long haul. Well, long haul, well, that really depends on how old you are and how long you can withstand losses and not go anywhere. So this is a very simple system that takes two long-term monthly moving averages. The green one is a 6-month, the red one is a 10-month. And I say it's simple because all we do is we look for when they cross over each other. So when the green line first, the 6-month first crossed the red line down here, that gave you the buy signal to enter the market. And that stayed in effect all the way up till we came into the beginning of 2000. And you'll see right here, the green line gave you the sell. So that was the time to start raising cash, perhaps going to more conservative investments. If you're aggressive, shorting. And that lasted for a couple of years into the beginning part of 2003. And then we got the buy signal again, right here. Green line crossed the red line. Several years go by. Didn't need to do anything. And then all of a sudden it rolled over again. Now, one thing I will point out, you're not going to get out exactly at the top. And you're not going to get in exactly at the bottom. But you're catching most of the big move, and you're out of the market and most of the down move. Same thing here, same thing here.
Just to understand, this is a monthly candlestick chart of the S&P 500, correct?
Correct.
Each candlestick represents 1 month of price action, and you've got two moving averages up there. You've got the slower moving average, the 10-month, which is the simple moving average, which is the red line, correct?
That is correct.
And then you got the green line, which is the faster moving average. The red is the 10-month, the green is the 6-month. The red is the slower line, the green is the faster line. And so that tells you when there's a crossover, when to get in. This is one very simple method of how to get in and out of the markets if you want to avoid those horrible drawdowns. Would that be accurate?
Totally accurate. And what's really nice about this system is if you're the type of investor that knows you need to be in the market for your whatever your goals are down the road, you don't have to look at the market every day.
Yeah.
Okay. You simply look at this once a month, and you can see, and by looking at that and following that, and look, if you go back to 1994, all you made was 1, 2, 3, 4, 5, 6, 7, 8 changes to your portfolio. Yeah. Very simple, very easy.
Right. This is just a simple crossover strategy that could have saved you a lot.
Yeah. Yeah.
Bundles.
Just one simple tool of the onion that we peel back.
There you go.
Gotcha. I like it. It's simple and could have saved a lot of trouble for a lot of people. It doesn't require a lot of monitoring or a lot of thinking. And just check it once in a while. Now, I do see a few times when the lines got really close but didn't quite cross. And so I'm guessing you're looking for a clear break. Would that be correct?
That is correct. And I didn't get into it over here. If you can see my pointer. Yeah. That I'm moving around. Okay, you had a couple of what they call whipsaws. This one I wouldn't really call it, but over here you got a sell and then you got a buy a few months later. Same thing happened up here. You had a sell and you had a buy back a few months later. So there were some extra switches if you want to count these two spots here.
Right.
But yeah, I mean, you couldn't have said it better, Dave. It's just a really nice system. It doesn't require a lot of work, and it keeps you in the long-term trends. It keeps you uptrends, and it keeps you out of the long-term downtrends.
Yeah.
So if you just look at this really quick, if you could have eliminated this, you literally could have taken this piece here, that bottom where you got the buy that, and just picked that up and thrown it on top of here, and your curve would be like this, right? Yep. And if you could take this piece out here and this piece right out here, and then take that and throw it on top of that, I can't even make my cursor go up that high.
Right,
See, I'm stuck. I mean, so that's where you'd be somewhere. I'd have to add another monitor, I guess. No, that won't work either. Yep. But anyway, there's one more quick thing I want to show you on this chart. And oftentimes I run into people that say, "Oh my God, this firm strategist said this and is calling for that," or I read this in the Wall Street Journal, or one of my best friends told me this. So I highly recommend that you try to filter all of any media, any tips, anything like that. And I'll just show you real quick here, because this ties in really nice with this chart. If we go down here on the very bottom, where we first got in back in 1995, right here, the talk of the day is nobody wanted to be in the market, okay? And matter of fact, this article right here, this brief article, talks about the fact that the Wall Street strategists out there are only half invested. That's ridiculous.
Yeah.
I mean, for investment firms to, on average, be half invested in the market, it just shows you how doom and gloomy it was.
Right.
And look what happened. Boom, proved wrong. And then my favorite lady, they actually used to have she's named, an indicator has been named after her, Abby Joseph Coyne. It's, because whatever she says, the opposite happens. She was on TV pumping. I remember this. She was on TV pumping, Dow something ridiculous like 13,000 when it was 6,000 or something like that. And that was right in here when we just started to fall apart.
Wow.
Over here we had the U.S. outlook for the market was sunny, mild, and barely a chance of clouds. Oh, great!
Yeah, no chance of me.
Yeah, you're right. There was no chance. There's no chance of clouds. They didn't tell you about the volcano exploding and hurricanes and earthquakes and everything else. Anyway, and then last but not least, I threw this in here. This guy, Mr. Robini, he's very well respected economist, strategist. From, I think, NYU. And so he's saying right here, okay, literally right here, when the green arrow crossed, he says, I would not buy any stocks, credit, and commodities, anything for at least a year. Right. And this is just the beginning of the end. Okay, yeah, well, it depends if you turn this thing upside down, it was the beginning of the end. So anyway, that's two rules of thumb. If you want a simple system, there you have it, and don't listen to the news. Right?
Gotcha. Makes sense. I like it.
All right, I'll move on. Let's see here.
Well, this plays well with the next one, the cycle of emotion.
Correct. Would you like to talk about this at all, Kim, or you want me to do it?
You can start everyone off.
Okay. Well, remember in the chart before, this is where we were kind of like 93, 94, kind of milling around. There wasn't really any interest per se in the market. I can tell you because that's right around the time I started. All right. And I remember studying for my Series 7, and it was like the Dow went up 7 points, went down 6 the next day, went up 9 the next. Then it was like watching paint dry. And and again, this area here is where the Wall Street strategists were only 50% committed to the market. And then what happened? Boom, breakout, and the market goes crazy, right?
Yep. And
so all of a sudden, the media is going, hey, what's going on here? Nobody likes stocks, and all of a sudden, market's, gone up 60, 70, 80%, whatever. So the media comes in, and then all of a sudden, once the media starts talking about it, people start getting interested. Hey, what am I doing? I got my money in a CD. I'm going to put it in the market. People are getting enthusiastic, coming in and opening accounts, so forth and so on. And as they saw how much money they were making, of course, the next stage is greed. That's probably right around the time when people started getting home equity lines of credit and taking the money out and putting it into the stock market on margin. Okay, so, and then you get to these are all, psychological stages, the way it works on the way up. And, then people get delusional. They think it's going to last forever. And of course, you will talk to people and you say to them, hey, listen, I hope you understand this is not how the stock market always works. Just so you know, I mean, you're not going to get 30% on Cisco for the rest of your life, or you'll be a billionaire. That's not going to happen. So, and then they tell you this time, things are different this time. And I don't know who coined that phrase, but somebody coined a phrase that's like, those are the four most expensive words on Wall Street. It's different this time. So, and now we can take that whole run up over 95 through 2000 and put it in reverse and let it unwind, right? So you have the decline, and when the decline starts, it's bigger than most people think. So people are in denial. Oh, it's going to be okay. And they get some vicious rallies in the bounce, and okay, everything's okay, and then you get a situation where this low gets taken out of this low, and it's like, oh my God, now I'm the one that bought in here at 1,500, and now the thing's at 900. Oh my God! And then it just continues to unwind. And excuse me, and you get down here where people start to capitulate, and then you get down to here at the absolute bottom, and all you if you were me, being in a brokerage office at the time, all you do is you can hear other advisors getting phone calls saying, sell everything, close the account, and send the cash. I don't want to see the stock market for the rest of my life.
Yeah.
So that pretty much wraps up the cycle of how this all goes. And then you have the cycle turns around, rinses and repeats, and we start all over again.
Yep.
So.
Right. And you can see that if you're, newer investors doing it on their own, will go through each of these stages, and you can cut that out by knowing ahead of time that you're going to probably go through them.
Yeah.
And so you can assess it from an objective, standing back. Non-emotion is why that's always said is have no emotion, because also in these stages you can see where people don't stick with their game plan because they're still going through one of these steps that they haven't mastered yet.
Right.
So that's important to keep in mind if you're trading your own money and your own 401ks, for sure.
Yep, absolutely. One thing
there
I
is
like
that
about,
curve.
If I could just say about CaptainJohnCharts.com, which I recommend everybody go and visit. I know that both of you do a lot of not only just advising and assisting people in getting the most out of their trading and investing plans, but also you help people through the emotional parts, the cycles, if you will, of investing and trading. You help people, you provide a lot of support on an emotional level for a lot of your clients. Would that be accurate?
Oh, absolutely. Absolutely.
Yeah.
That's an important thing, because it depends on the perspective. If it's a client, it's a different thing. If it's someone who needs help and they're wanting to invest their own money, we provide the coaching and support that they need, because we know where they're going to reach certain stages and stumbling blocks, and it depends on their skill level too. Some people come with relatively little skill, and so they get to fire it up right away, and they don't have to go through those unnecessary drawdowns that make you give up.
Yeah. Yep, absolutely. And again, tons of resources over at CaptainJohnCharts.com. If you haven't signed up for their free email list, go over to the website and do that. For goodness sake, you got nothing to lose. That's a free service, got resources on there as well as premium services. Because both Kimberly and Captain John will help you through the process of learning how to read and interpret charts, and how to be profitable on a consistent basis while maintaining a risk profile that is reasonable. All right, and that way you don't have to go through the horrible parts of this cycle. You don't have to go through don't let the market cycle you out and shake you out of the tree, as they say. Excellent. I love these charts so far. What else do we have? I can't wait to see it.
Okay, moving on. So I'm going to just real quick mention again, don't forget the 6 month, 10 month crossover. Okay, we only really talked about going from stocks to perhaps cash. Let's just say those two. All right, switching back and forth. That's all you needed to do. Now, what we do from the big picture standpoint is we look at what is going on around the world. So we want to know, where is the relative strength? What asset class is outperforming the next asset class, and what asset class is performing that one, and so forth and so on. And we do that using point and figure charts. Also use regular bar charts or line charts to compare in different time frames how one asset class is comparing. So just like you saw the switching between the moving averages, it's very similar from the standpoint we will switch asset classes. There's a time to be in cash, there's a time to be in bonds or overweight cash, there's a time to overweight U.S. equities, there's a time to overweight international. What we're showing here is a current allocation top down. Right now, if you look at the top here, right now U.S. equities and international equities have really been the place to be. International coming on, I guess, maybe about 6 months ago. U.S. has been the place to be for quite a while, a lot longer. And then commodities of late have been coming on. Bonds really haven't been worth it in terms of any kind of great performance asset, rising asset wise, or with their coupon payments, their interest rate, and then cash, of course, really hasn't been anything other than a place to hide if things get really bad. So that's what our current allocation is favoring is U.S. equities, international equities, and if you want to dig down inside of international equities, we break it down to developed markets and emerging markets, and we compare those two to see where we want to overweight, which we can get to a little bit later. Yeah. These two down here aren't anything more than me saying to you, Dave, Kim, maybe we don't know, we don't have a crystal ball, but maybe 6 months from now, 9 months from now, 6 weeks from now, who knows? Maybe commodities will be the first place to be. And maybe U.S. equities will fall to number 2. Or in this case down here, be last case. If you see cash in number 1 and bonds in number 2, we got a little bit of a problem.
Okay?
Right. Because that's what happened. That's what happened. Started happening, right before the financial crisis happened. So that's taking it from switching from cash to the market to a little bit more bigger picture view of other different asset classes we have choices to go to. And so you might say to yourself, okay, well, if U.S. markets or U.S. equity markets are favored, what is driving them? Okay, let's look under the hood. And the way we look at it, we say, okay, what is it? The large cap part of the market? Is it the mid cap that's moving it? Is it small cap, so forth and so on? In this case, at least over the past couple of years, more than likely you probably saw the Nasdaq or the Nasdaq 100, which is the top 100 Nasdaq stocks. If you get the ETF, it's called QQQ. That's been the leader. So it would make sense if you are going to allocate some of your money to U.S. markets, you're going to want to overweight Nasdaq type stocks. And you could just walk away from it and watch the relative strength and just leave it there by the QQQs with part of your money. Or some people will say, hey, well, since you're digging inside, let's say the New York Stock Exchange, you're digging inside the S&P 500, what if we dig down even more? And we find out the Qs is the number one place inside. Well, what's inside the Qs that's working? And so I put together a list here of high relative strength exchange traded funds, and the ones that have circles next to them are things that you would find in the Nasdaq 100. So solar, online video, online shopping, social media, and various technology. Yeah. And that is really what tacked on the alpha or has been tacking on the alpha for the Qs. And we know that international is number 2 in our asset ranking system. And so we did a relative strength test and came out with what the countries were. Now, if you see this, right, you'll see that they all favor, almost all of them favor emerging markets. So we know that from a relative strength basis, if we're going to do something in the international markets, and of course, if you have the heart to play some of these because they're a little volatile, the place to be is emerging markets. So
interesting.
And so for now, we're just going to focus on the U.S. and we'll touch a little bit on the international later. Right. And what I'm showing right here, real quick, just as a visual, here is a chart of the Nasdaq 100, a bar chart. Okay, and you can see that it looks bullish, right? It's going up left to right. Mm-hmm. And this is taking the Nasdaq 100 and dividing it over here by the S&P 500. So you can see we're going back to 2000, say, call it 2008, all the way up to currently. The chart's going up left to right. That means Nasdaq 100's outperforming the S&P. So going inside, again, going back to those exchange traded funds, these 4 exchange traded funds, they're inside. A lot of what they hold is inside the Qs. So we looked at these because these were all the ones that were ranked in that first piece that I showed you with the exchange traded funds. And what did we find? We found, if you want to dig down inside of those, what stocks are powering those. And if you look inside and run relative strength ratings on stocks, you'll find that one of the ones that pops up, has been popping up, is Netflix. So getting down to the stock picking level, giving you an example of what Netflix did, and we're going to actually go to the chart of the price chart of Netflix. And here's where we start looking at things besides relative strength and things of that nature, and start just simply doing old-fashioned charting. You see Netflix was forming a symmetrical triangle here.
Mm-hmm.
It finally broke out, which is bullish, and ran up. Started to form another somewhat of a triangle, smaller triangle here, and then broke out. And so, obviously this is an extreme example, but these are things you like to find, and hopefully you find a bunch of them. But going back from when this was forming and breaking out in September of 2016, you'll notice that the returns were quite spectacular. So that's the perfect situation to see happen. You found the right. You knew to be in the market, number one. You knew where to be inside that market, which you'd overweighted the Nasdaq. You knew what was making Nasdaq work. Well, it was solar. It was online gaming. It was gaming, video gaming, online merchandising, and a few other things. So you focus on that, and then if you say, well, you know what, I don't want to buy that ETF. I'd rather find out the top 3 or 5 stocks inside that ETF and try to get more off of that way. So it's really up to the individual. But again, it's a top-down, and you just keep on opening the hood on what's next until you get to the point where you're comfortable. You might like stocks, you might just be comfortable with ETFs, right? Nothing wrong with that.
Sure. Very good.
Right.
All right. So what's next?
Food this up. The only thing I'm missing here is I don't have the date, but I can tell you that it was the last 6 months of 2017, and it probably goes through right before the whole thing happened in February with the pullback. So it's roughly 7 months. But just for kind of give you an idea, I took the names on the U.S. side of those ETFs that I showed and put them up here. And here's some of the international names. I put them down here, and you can see that the gains were all positive for that 7-month period. Certainly, outperforming the market significantly. Same thing happened with all the international. I mean, 7-month gains like that are for some people they don't get half that in a year. So,
Right.
Just to put some perspective on what you could possibly if you get it, things go right for you, selecting the right ETFs using relative strength, that the rewards can be quite handsome.
Sure. I really like this system because we're looking outside of just American equities, American ETFs, nothing wrong with those, but we're looking around the world. We're looking at emerging markets, we're looking at other countries, and we're looking at commodity ETFs, sector ETFs. And with that system, you just showed us how you can handily beat the S&Ps. So that's pretty impressive. So it looks like we have something else about emerging markets here. What is that?
Right. And I briefly touched on this when I said, when we were looking at the 5 different asset classes, I said the international, we break down into emerging and developed. Well, someone might say, well, how do you know which one to pick, right? That's the obvious question. Mm-hmm. And so one easy way to do it is I used the EEM ETF, which is the emerging market ETF, and took the EFA, which is the developed market ETF, and simply divided one by the other using a chart. Now, I didn't sit here and figure out all these calculations. I thought the chart do it for me. And you see here from the 2009 low up to looks like the middle of 2010, there was significant outperformance, and then things kind of tailed off. Well, I should say significant outperformance by the emerging markets. Anyone's guess, I would say probably because they probably got beaten up the most, so they were the spring to pop the highest, the fastest. And then we had a period here from, call it 2012 until last year, where it was underperforming. Okay. And then all of a sudden, these green circles are just showing you where the trend line developed, the downtrend line developed. We got a breakout. Now, to us, that means that we start moving away from developed back into emerging, because that downtrend line got penetrated, and then a horizontal chart line got penetrated. So right now we like emerging markets versus the developed. An easy way to help you, guide you to make the decision is just to use a simple relative strength chart. You can do it using a monthly chart if you're longer term, like I did here. And you can do it, using a daily or a weekly, whatever suits your time, time horizon. So,
Yep. Makes sense. I like it.
Here's another example. Yeah.
Wait, let me guess. Inverse head and shoulders. Did I get it right?
Oh, yeah. Kim, did you get it? Kim, why don't
He
you
sure
take
did.
Oh, cool. All right.
One of my favorite patterns.
Wow. Very powerful pattern, right?
It's an extremely powerful pattern that can yield some fantastic results. And you can measure from the neckline to the head and kind of project up what you will have as a reward, which makes it like a nice low risk. And that's what you're looking for. And to see that in the comparison with these two ETFs, it's, how to position yourself. Yeah. You know how to shift and allocate then.
Right.
Yeah, very good. It's a powerful pattern. Yeah.
It is a powerful pattern. It just shows you this is a relative strength chart here again, and that you can use these patterns not just on price, but on relative strength price. Okay? So good to know.
Gotcha. Very cool.
And this is an example of, we were talking about this the other night, if you're in, say you're in U.S. markets and you're in international markets, we already know that's the place to be. Doesn't mean that there might not be something in another asset class that's standing out by itself. Mm-hmm. So you don't want to avoid those situations. And clearly here, this is, we know developed markets inside the international is not the favorite part to be, but Italy's doing great, right? Or at least it was until last week or so. And here you see it breaking out. Over here, you see that there's a head and shoulder bottom here, kind of hiding out. It broke out, and then it came down. We like it because the point and figure chart has a vertical price objective of 63, which is quite large from here. Right. Probably it's going to take a long time for that to get there. But just to show, hey, there are opportunities everywhere. When we talk about overweighting an area, that's one thing, but you can find stuff in other places too.
Yeah. Right, and I would say too that usually, like once you see that break, you can anticipate there will be a throwback to retest that break, and that's a good time to really get in if you missed it the first break.
Right.
And that's usually when you see that it tries to start going towards its point and figure price objective as well. So that's good to know.
Sure. Yep. I like the way you confirm with the trend lines on the candlestick chart and then with the point and figure chart, they both confirm each other through your system. And
right.
These are all on CaptainJohnCharts.com. You can learn about all these different types of charting systems, and you also want to check out their premium resources as well, which are definitely a great resource for people who want to outperform the market, who want that kind of alpha. You'll get not one but two experts in the niche guiding you through. They're very accessible. Both Captain John and Kimberly, both very accessible, and they're going to help you through. So you can learn to do this on your own if you want to, or you can just trust them as resources as well. Very cool. So what else we got here?
Okay. This is same thing. Looking at Italy, and this time we're dividing it by FIFA. Okay, so we're seeing how it's doing on a relative strength basis, and you see over here we got the breakout. So we like, what we do really love is we love seeing price breakouts and simultaneously seeing relative strength breakouts.
Yeah,
absolutely.
I think it's really nice. You got the hand in hand thing going on.
Right. Like I said earlier, it's like peeling back the layers of the onion, and that's what we're showing you. We're going inside. Here are some more powerful patterns that, like, look at on the left.
Yep.
That's the head and shoulder pattern.
Mm-hmm.
And that was an 81% drop to the bottom.
Yeah.
So, and that's a 437% gain to break even. It's not going to happen. And so on the right too is another powerful pattern. These are just types of chart analysis. There's many different techniques, but one of them is like knowing these patterns and knowing them well and looking at the other evidence that you find that overlays and correlates to this. So as you can see in that bearish wedge, once it tested that bottom support and went through, it was done.
Yeah, yeah.
And that's how you know to cut the losses short. If it violates that important level, you have to have the fortitude to say, I'm not going to average down. I'm not going to average down, because average down doesn't work as we see on the right. You can average down sometimes till stock goes to zero.
Yeah. Yep. Mm-hmm. You can average down your way to being broke, and
right.
These patterns have helped people if they followed what Kimberly and Captain John, if they follow the teachings and the instruction here, they could have saved themselves a lot of heartache and a lot of financial loss by getting out with minimal loss at the right time through these patterns. Mm-hmm. But you have to know how to do it. You need a mentor or two. You need guidance.
Right.
I would not recommend trying to do this on your own, just guessing and trying. That could lead to a lot of problems. So
absolutely.
Yeah.
It's great to have a mentor, a teacher. I was taught. John is the one who taught me. I'm John's apprentice, and what he's taught me has literally accelerated what I knew from when I began. And I remember being a beginner because I'm younger in the sense of age of the market compared to John and many others I've met. So a mentor is very important. That will start you off and make you independent.
Yeah. Mm-hmm.
Yeah.
Very good.
If I could just step in for a second before I let Kim go on. This kind of ties into sentiment a little bit from earlier. If you look over here it's up here, Philadelphia housing sector, as Kim mentioned. This head and shoulder top took place in 2004, 2005. The right shoulder didn't happen in here. Anyway, if you think back, probably everybody that you talked to would have said nobody saw this coming when it came to the financial crisis. I heard that from everybody. Nobody saw this coming. And when it collapsed, everybody said to themselves, well, I guess we're all in it together. Well, yeah, you are. Do what everybody else does, get rid of what everybody else gets. Okay? This head and shoulder top was well in place before the financial crisis happened, meaning that it forecasted the financial crisis. And and the price target was not only met on the head and shoulder, but it was exceeded. So if you talk to anybody back here, you went out and about to a cocktail party or whatever it might be, you would have seen nothing but real estate agents and mortgage brokers. Okay, and they're talking to you about how it's never going to end. It's the same thing as the stock market right before the .com. It's never going to end. It's different this time. Right. And well, it was different, all right. And over here, real quick, DDD, the whole thing with the 3D printing, which is kind of cool. I'm not saying that, but people went nuts over this stuff. I mean, the stock went from $8 to $80 in almost no time. So this was when people got delusional, and look what happened. Boom.
Yeah. Right.
Couple of months. All right. Sorry, Cal. I didn't mean to cut you off. There you go.
That's okay. Those were good points. So, okay, here's some more here's the ITB, the home builders. I remember specifically giving the information on social media about I was like pounding my fists on the table of how bullish these were. However, the sour mood overshadowed So people remained in disbelief as it just ran and ran and ran. And look at this beautiful inverted head and shoulder.
Yeah.
Again, this pattern, these are repeatable patterns that have, for decades, that work out. Now, if they fail, they can fail. You'll know and you'll cut it quickly. But here's on the right too is the EEM. And there's a bullish wedge. And you see what happened after the bullish wedge breakout. That's a considerable amount of gains, and those are recent too. These are actually the recent charts. That's the daily, and the weekly on the left is the ITB. That's the weekly chart. So, and take a look at different time frame charts too. You can't always just monthly.
Sure.
You have to have daily, weekly, monthly. So
absolutely.
You can find patterns within the patterns.
Very good. All right. Wow, this is a lot. And these are textbook patterns. I mean, I can recognize these. Even I can learn from this. And if I can learn from it, I think anybody can. So this is very learnable, very teachable, very doable. I like it. Great. Anything else? There's more. Oh my goodness, fibs.
Do we know fibs, David?
We have to cover Fibonacci numbers.
All right. Real quick, I'm sure a lot of people know what Fibonacci's numbers are, but a quick refresher, we simply add these numbers up. 1 and 2 is 3, 2 and 3 is 5, 5 and 8 is 13, so forth and so on. The significance of that is that you are able to take any of these numbers and divide it by the prior number, and you get what comes out to be what they call the golden ratio, which is 1.68. So real quick, I divided here 987 by 610, and look, we get 1.618. I took 317,811 divided by 196,418, and once again 1.68. If we take the inverse of that, we get 0.618. Both used as Fibonacci numbers. Now, where that applies is if you do some Google searching, you'll find out how fascinating this stuff is, because it appears in all types of animals, plant life, vibrations and music, so forth and so on. It also applies in the stock market a lot more than you think. A quick example is a chart of IBM, and we see the low in the early 90s. We see an enormous rally back up here, and then a pullback. And when things pull back, people who study retracements and support lines and things of that nature, which we do, of course, we're looking for different Fibonacci retracements, and look what you had. Stop dead nuts on 0.618.
Right.
Wow, that's perfect.
Yeah.
Bounced right off of that level there. That's wow. That's again, textbook right there. That worked out perfectly.
All right, let's get to the next one here. Another quick look at Fibonacci. Here we're looking at a chart which we currently like. It's a chart that goes back 43, 44 years of General Electric in an uptrend. And you'll see that it pulled back to the uptrend recently. We're still waiting on it. It's a monthly chart. Even though this is not the 0.618, 50% is also used as a Fibonacci number as a retracement. So we got two things showing us that possible support's happening here on a long-term chart.
Right, in such long-term support, you would expect to see a bounce at that point, and look for that, the confirmation hammer, a hammer candlestick. So,
gotcha.
Oh, this is great. These are the divergences. This is a key thing to look at, are the divergences.
Huh.
So you have the two divergences going on. You've got momentum. Look at momentum at the bottom. I would say at number 2, where that arrow goes up, is equivalent to drag racing when the light goes. Okay, because that thing accelerated, and then you have the bullish divergence showing up in price. So you have price and momentum, and that is fantastic. Yeah. That's a fantastic bullish sign.
Gotcha.
Yeah.
So when you look at the RSI, the momentum indicator, you could tell that the candlesticks don't tell the whole story necessarily. and
Right.
you can look for a bullish divergence and see that, you know, maybe there are things going on under the hood that if you know how to look for them, you can capitalize on that. Yeah.
Right.
Yes.
Very good.
Okay. Another indicator that we look at, David, is the advanced decline line, and that's simply the number of stocks going up versus the number of stocks going down. And what's important about it is, more often than not, the New York Stock Exchange advanced decline line, or any advanced decline line for that matter, typically will turn down as an early warning of trouble to come before the actual asset turns down. And conversely, it tends to turn up before the asset turns up. So what's nice to know that, just to keep in mind and watch that at least on a weekly basis to see what's going on. Because if the advanced decline is rolling over, that means fewer and fewer stocks, and it's usually the generals are the only ones that's left to shoot. It's just an early warning signal it's great to know about. It can be used to do divergences. Here's an example. The top line up here is the New York advanced decline line. Down here is the actual New York Stock Exchange composite. And you'll notice down here, while the New York composite was making a higher high here and a higher high here, it was also making a higher high here.
Right.
But the opposite was happening here in the advanced decline line. Higher high, lower high, higher high, lower high.
Interesting.
Big higher high, big lower high. And look what happened after.
Yeah.
I mean, it's picture speaks 1,000 words, right? So that's
The
the advanced decline.
AD line telling the tale before the candlesticks. Interesting. I'll be looking more at that more closely
Yeah.
for sure.
It's like the town crier.
Yeah. Okay. I got it.
He's got the only one that was crying were these people down here. So,
Yeah.
Right.
right. All right. We wanted to just right here in this chart, give you a visual of a strategy which we showed you earlier. This has 5 different investments. It has international equities, U.S. equities, mid-cap equities, emerging market equities, and cash. And it's simply a relative strength switching strategy. And what's really nice about this is, number one, it's an 18-year chart. And this is the chart. The blue chart is the chart of the relative strength switching strategy. It looks at the top 2 of those 5 asset classes once a month. And if after a month, those 2 are still the best performing and relative strength, and this stays there for another month. And it'll keep doing that until one gets kicked out, gets replaced by another, or if they both get kicked out, they both get replaced by another. And so it's flexible because it can move around all over the world, and it can go to cash if it has to. And just eyeballing it, you can see that comparing it to the S&P 500, which is we're using the Vanguard 500, basically same thing, and the equal weight S&P 500, which is simply the S&P 500 that gives only 1% weighting to each component. And both of these are way down here, right? And look at the outperformance. So that's one key to having great relative strength. The other, well, here's the numbers actually. You'll see that over that time period, the S&P 500, a $10,000 investment over over 20 years, amounted to 40,000 plus, 49,000 for the equal weight, but the relative strength model grew to 146,000.
Wow.
Significantly outperforming these two. So that's the great news from the upside.
Yep.
Okay, significant outperformance. Now for the downside, right? We always said that's equally important, if not more important.
Right.
The downside, the worst year in 20 years was down 11% for the relative strength model. For the equal weight, down 43, down 37. Not too much fun, right?
Yeah.
And when it comes, having a worst year is bad enough, but having a max drawdown that's pretty bad is even worse, because you want to sleep at night. You're not going to be able to sleep being down 57%, I don't think. So while the relative strength model is not perfect, The worst case was a 22% drawdown, and worst case over here, 57 and 50. And also, last but not least, the correlation to other things such as the S&P equal and the S&P 500 is a little more than half correlated, which is nice. So if you had something else you wanted to invest in, compare it and see correlations and things of that nature.
So you can beat the S&Ps. Yes, folks, it can be done.
It is possible.
Absolutely.
Well, every strategy has its weak points here and there. We know that. But there's plenty of white papers and there's plenty of books written on the concept, and you will find whether you're looking at what we do or others that use either some of relative strength or all of relative strength in various different ways. It seems to be proven that it is consistently a part of every successful investment strategy.
Right, and if you take a look at the timing portfolio of ours, and if you're an investor or even an advisor with your own firm and you need a spare set of eyes, would you rather be red or yellow or blue like us? It's pretty obvious on here, the drawdowns. I mean...
Yeah, I'll take the blue. Yeah.
Yes,
Blue.
exactly. These are just the types of things with the type of research and strategies that we use that make all the difference in the world. That's why our key thing is, it's one thing to get the winners and get the right exits, but or entries, you also need the right strategies that get you out and you take the exit.
Yep. Hugely important. Absolutely.
Mm-hmm.
Wow. Very nice. Great results there. Fantastic.
Thank you.
Yeah. All right. So, did we miss anything? I think
that wraps it up.
Quite a thorough presentation.
Well, thank you.
My goodness. Oh, my brain is full of charts and lines now, and heads and shoulders, and knees and toes, and oh my goodness.
It's chart happiness.
Oh my good. I'm going to have to review this video multiple times just to absorb it all. And but for those of you who want to learn more, again, it's CaptainJohnCharts.com. Link is below this video in the description. And also, you need to be following Captain John Bukowski and Miss Kimberly on Twitter and on StockTwits. Let's see if I have memorized this. On Twitter, it is CPT John Charts on Twitter. Am I right?
Yes.
Yeah, handle on Twitter is CPT John Charts on Twitter for Captain John, and Fortuna Equitis for Miss Kimberly on Twitter and also on StockTwits. Now for Captain John StockTwits, is it just Captain John or Captain John Charts?
Just Captain John.
Just Captain John. Okay, I was almost right. I'm going by memory.
Close enough.
That's it.
And you can forgive me for that one, hopefully. So, I'll put those all those handles in the description of this video. And if people want to contact, Kimberly and Captain John, they're both very accessible. There's a contact page right there on CaptainJohnCharts.com. Fire away your questions, your concerns, or better yet, just sign up. Sign up for the free email list and for the premium resources, which are certainly well worth it. I mean, just look at that chart right there. The drawdowns, drawdowns are never fun, but I can handle a 10, 15%, 11% drawdown if that's the worst case scenario, as opposed to, the S&Ps, the Equal Weight portfolio, the Vanguard 500 index, which is supposedly safe, but look at those drawdowns. Look at that 50% plus one right there. Look at that 45% plus one there. That's no fun. Most people don't have the stomach or the time horizon or the resources to withstand that type of drawdown. So I'm really impressed, guys.
Thank you.
Yeah. So people just need to head on over to the website and check out all the resources. Did I miss anything at all?
I think you covered everything, David. It's fantastic.
I think you covered everything. And you
We got it covered. Whether you're an advisor or an individual investor, we get a lot of calls and emails. There is no silly question.
Right.
Some people just call us to chat. We end up chatting, but a lot of people, they do have, very burning questions that are keeping them up at night. And we've had advisors and different types of people that are looking for maybe just using one of our models so that they can spend the time with their clients and generating more. So we're accessible, we're chatty, just email, call, text, and we're there.
And most importantly, go to that website and find out more about CaptainJohnCharts.com. I want to thank both of you for providing all this excellent all these charts and all these ideas and ways to minimize risk, get that alpha, maximize results. And I know I want to learn more, and people should definitely check that out, and also on Twitter and StockTwits. So thank you so much. I hope you'll be frequent guests. Thank you, Captain John Kimberly.
Thank you so much, David.
Thanks, David.
All right.
Love to be back on.
Awesome.
Yes.
Talk to you both next time on Looking at the Markets. Thank you for watching. Please like, comment, and subscribe. And I'll see you next time.